If you think saving money will make you wealthy, it won't. Come close. Because your bank is robbing you, and you're letting them. They're paying you pennies while using your money to fund credit cards, charging everyone 20, even 30% interest, including you. And the longer you wait to invest, the more it costs you. Let me show you how. Most people are doing everything right and still not building wealth. They work hard, they save money, and hope it's enough. But it isn't. Here's the problem. Saving alone will not build wealth. That's exactly why investing matters. And if you've ever felt behind, confused, or unsure where to start with investing, you're not alone. So in this video, I'm going to break it down. In plain English, I'll show you what the stock market actually is, how investing really works, and exactly how to get started, even if you're starting small. No jargon, no guesswork, just a clear path forward. And if you're wondering, did I already miss my chance to start investing? You haven't, and no, it's not too late. The best time to invest was yesterday. The second best time, right now. But before we go any further, I need you to hear this. Even if you're dealing with high interest debt, no savings, or no emergency fund, this video is still for you. Because you don't need perfect finances to start. The goal isn't to choose between paying off debt or investing. It's to build momentum in both. So let's start with the basics, because before you invest a single dollar, understanding how the stock market actually works is everything. We've all heard the term, the market. It's everywhere, on the news, in conversations, in movies where someone is always yelling, buy, sell, like their life depends on it. But what is the stock market really? Here's the simplest way to think about it. The stock market is just a giant marketplace, like Amazon. But instead of buying electronics or gadgets, you're buying pieces of companies. That's it. No secret underground vault, no Wall Street wizardry. Just a marketplace where everyday people, including you, can own a slice of some of the biggest companies in the world. When you buy a stock, you're buying a tiny share of ownership in a company like Apple, Microsoft, Netflix, or Starbucks. And when those companies grow, your piece grows as well. Now, instead of checking every company like you're cramming for an exam, the financial world provides us with something much easier. Indices, which are basically giant scoreboards that track groups of companies and give you a quick read on how the market is doing overall. Here are the three major ones you need to know. First up, we've got the S&P 500. This is the big one, the one that really matters. It tracks the 500 biggest companies in the US, so it's basically the report card for the American economy. If someone asks, how's the market doing? This is what they're usually talking about. Then there's the Dow Jones. This is the old school index, the one everyone was talking about back in the day. It only tracks 30 companies, which is not a lot. But they're the big legacy brands like Coca-Cola, McDonald's, and Walmart. So it's important, just not the most complete picture. And finally, NASDAQ, the tech playground. This is where the overachievers live. Apple, Google, Amazon, Microsoft, all the big tech names. So when you hear the NASDAQ is up, it usually means tech stocks are having a good day. Now, all three of these indices give you a window into how the market is doing. But if you only follow one, make it the S&P 500. It covers the biggest companies in the US, including many that are also in the Dow and NASDAQ, so it gives you the clearest overall picture. So again, when people say the market is up, they're usually talking about the S&P 500. And when it drops, that's when the media kicks into full drama mode. Market meltdown. Panic on Wall Street. But here's the part they never highlight. the market has always recovered. Always. The lesson? Focus on the long term, not the day-to-day swings. And one more thing, the stock market isn't a casino. It's a long-term wealth machine. And when you understand how it works, even at the most basic level, fear starts to fade and the opportunity becomes crystal clear. So now that you understand what owning a stock actually means, let's talk about how investing works in the real world. Because even though companies like Disney are publicly traded, you can't just go to Disney's website and buy stock directly. Instead, you buy stocks through something called a brokerage. Just like Amazon lets you buy products, a brokerage lets you buy stocks, ETFs, and other assets all in one place. And once you use a brokerage to buy a share of Disney, you officially own that piece of the company. Now, if brokerages seem a little confusing right now, don't worry. I'll walk you through exactly how they work step by step a bit later. But first, let's talk about how you actually make money from owning stocks. Basically, there are two ways. The first way is through appreciation. In other words, when the price goes up and you sell it for more than you paid. For example, if you bought Microsoft stock back in 2020 at around $167 a share and held on to it for several years, you could sell it today for significantly more. That difference between what you paid and what you sold it for, that's appreciation. The second way stocks can make you money is through dividends, which are a lot like rental income. Some companies, including Microsoft, Coca-Cola, and Disney, share a portion of their profits with shareholders. And that payment is called a dividend. So instead of only hoping the stock price goes up, you can also earn money simply from owning certain stocks. Think of it this way. Appreciation is what you earn when you sell the stock. Dividends are what you can earn while you hold it. Let's break down the Microsoft example even further. Say you owned 100 shares of Microsoft, and the company pays a quarterly dividend of 83 cents per share. That's $83 every quarter, or 4 payments per year. Now you could take that money as cash, or you could reinvest it automatically using something called a DRIP, or dividend reinvestment program. And if you invest in multiple dividend-paying companies, those payouts can start to feel a lot like passive income. Similar to collecting rent, except without tenants. Now this all sounds great, but here's the catch. Trying to pick the right individual stocks isn't easy. I mean, which companies should you actually buy? Should you put all your money into Apple or Netflix? What about Alphabet, the parent company of Google and YouTube? Or maybe Coca-Cola, Disney, or ExxonMobil? This is where investing starts to feel overwhelming, because opinions on stock picking vary wildly. And even professionals don't agree. So instead of guessing, let's turn to someone who spent a lifetime investing successfully, billionaire investor Warren Buffett.
The average person will not know enough to know which stocks to buy. They won't know enough to know when to buy them, but they don't have to, because if they can buy all of America through an index fund.
Now you've heard it directly from Warren Buffett himself. For most people, index funds are one of the easiest and smartest ways to invest. And that's exactly what we're diving into next. We'll break down what index funds are, how they work, and why they're ideal for beginners. Because once you understand index funds, investing stops feeling complicated and starts feeling doable. The easiest way to think about a fund is this. It's like a big basket. And inside that basket are lots of different investments, usually stocks, grouped together into one product you can buy. But here's the important distinction. The index is just a list. For example, the S&P 500 is a list of the 500 largest publicly traded companies in the U.S. the Dow Jones is a list of 30 legacy brands like Procter & Gamble, Coca-Cola, and McDonald's, whereas NASDAQ leans heavily towards tech and growth companies. An index fund, on the other hand, is the investment that tries to mimic one of those lists. So, if a fund tracks the S&P 500, it's designed to represent the 500 largest publicly traded companies in the United States. Companies you've absolutely heard of like Apple, Walmart, Visa, and Google. And when you hear someone say, I invest in an S&P 500 ETF, what they really mean is, I invest in an index fund that tracks the S&P 500 and it's packaged as an exchange-traded fund, or ETF. This matters because people often think ETFs, mutual funds, and index funds are competing investments, but they're not. An index fund describes what you're investing in. An ETF describes how that investment is structured and is basically one way to access an index fund, while a mutual fund is another. So now that you know what an index fund is, let's walk through how ETFs and mutual funds fit into that picture and the key differences between the two. The first big difference is how they trade. ETFs trade throughout the day just like stocks. You can buy or sell them whenever the market is open, and their price moves as the stocks inside the fund move. Mutual funds, on the other hand, typically trade just once per day after the market closes at a single price. Another major difference, and this one really matters, is cost. Many mutual funds, especially actively managed ones, have managers or teams constantly buying and selling stocks in an attempt to beat the market. All of that activity increases costs. Those costs get passed on to you in two ways, through higher fees and often through higher taxes. With ETFs, the approach is usually much simpler. Most ETFs are passively managed and designed to track an index, which means less buying and selling inside the fund. And because of how ETFs are structured, they tend to be more tax efficient. To put that in perspective, many actively managed mutual funds charge expense ratios of around 0.50% or more, while broad-based index ETFs often charge closer to 0.03% to 0.10%. That fee, called the expense ratio, may sound small, but over decades it can have a massive impact on your returns. Let's put that into perspective with a simple example. Imagine investing $100,000 for 30 years, and both investments earn the same average market return of about 8% per year. On one side, you have an actively managed mutual fund charging a 1.5% annual fee. On the other, a low-cost index ETF charging about 0.03%. Even though both investments follow the same market, those fees quietly compound against you over time. After 30 years, the mutual fund grows to about $661,000, while the low-cost ETF grows to roughly $993,000. That's a difference of over $330,000 lost entirely to higher fees. And here's the part most people don't realize. In investing, something called compounding does most of the heavy lifting. Compounding simply means that your money earns returns. And then those returns start earning returns too. Think of it like a snowball rolling downhill. It keeps getting bigger as it goes. Over time, that snowball effect is what allows investments to grow exponentially. But here's the catch. Those fees aren't just a one-time cost. They're taken every single year, which means each year a little bit of your investment is quietly siphoned off before it has the chance to compound. And the next year, you're compounding a smaller amount of money. Over decades, that lost growth compounds too, but against you instead of for you. That's why what looks like a tiny difference, 1.5% versus 0.03%, can quietly cost you hundreds of thousands of dollars over a lifetime. And that's exactly why keeping investment costs low is one of the most powerful decisions a long-term investor can make. There's also the cost of entry. ETFs can usually be purchased for the price of a single share, and often even a fraction of a share. While many mutual funds still require higher minimum investments, sometimes in the thousands of dollars, depending on the fund and the platform. And yet, many workplace retirement plans still rely heavily on mutual funds, largely because of how those plans were originally designed, not because they're always the most efficient option. We'll dig much deeper into all of this in the next video, how to invest in ETFs. For now, just know this. For the majority of individuals, ETFs are often the more efficient and flexible choice. Now, I keep mentioning the S&P 500 for a reason. That's because it's one of the most widely followed indexes in the world and is basically a who's who of American business. Together, these companies touch nearly every part of the U.S. economy and represent a large portion of the total value of the U.S. stock market. So when the S&P 500 grows over time, which historically it has, it's often a strong indicator that the broader U.S. economy is growing too. And here's why that matters for regular investors like you and me. Instead of trying to guess which single company will be the next big winner, you can invest in an index fund that tracks the S&P 500 and automatically own a small slice of hundreds of companies at once. You're not betting everything on Apple. You're not betting everything on Amazon. You're investing in the collective growth of some of the most influential companies, not just in the U.S., but the world. And that's the real power of an S&P 500 index fund. You're participating in the growth of the U.S. economy as a whole without having to time the market or constantly manage your investments. Let's see what this actually looks like with real dollars. Say you invest $1,000 into an S&P 500 index fund. That $1,000 doesn't go into one company. It's allocated across hundreds of companies based on their size in the index. Larger companies make up a larger portion. Smaller companies make up a smaller portion. But you're invested in all of them at the same time. So companies like Apple or Google carry more weight, while smaller companies still play a role, just to a lesser degree. Right now, if you look at the top of the S&P 500, you'll see companies like Apple, Nvidia, Microsoft, Amazon, and Alphabet, which is Google, plus hundreds more. Now let's go back to our example. If you invested $1,000 into an S&P 500 index fund, roughly 6% of that might be allocated to Apple. So you'd own about $60 worth of Apple. Another portion would go to Nvidia, another portion to Microsoft. Smaller amounts would go to hundreds of other companies further down the list. You're not trying to memorize these percentages. The point is this: your money is automatically spread across the entire index. So instead of asking, which stock should I pick? You're really asking, do I believe American businesses will grow over time? If one company has a bad year, it doesn't sink your entire portfolio. Other companies help balance things out. And as companies grow, shrink, or get replaced, the index adjusts automatically. That's diversification by design. And it's exactly why Warren Buffett recommends index funds for most people. Because historically, it's been a very good bet.
In my view, for most people, the best thing to do is to own the S&P 500 index fund. People will try and sell you other things because there's more money in it for them if they do.
And he's absolutely right. The truth is, very few people, even the professionals, can consistently beat the S&P 500 over the long run. This is why index funds are so powerful. You're not trying to predict which company will win next year. You're not reacting to headlines. You're not guessing. You're investing in the idea that, over time, the most successful companies in the country will continue to innovate, grow, and adapt. And you're riding their growth over time. Some will fall out of favor, others will take their place, and the index adjusts automatically. So instead of constantly making decisions, you let the market do the work for you. It's not passive because you don't care. It's passive because it's efficient. So why complicate things? Invest in an index fund and skip the stress. It's simple, low maintenance, and historically, it works. Now you might be thinking, okay, this sounds great. I want to invest in an index fund. How do I actually do that? Do I just head over to some website like S&P500.com and buy one? Not quite. Investing in index funds works a lot like buying stocks. You still need a middleman called a brokerage. A brokerage is simply an online platform that lets you buy and sell investments. The right brokerage for you depends on a few things: your goals, your level of experience, and where you live. As an American, I personally use and trust platforms like Fidelity, Vanguard, and Charles Schwab. They're all well established, offer a wide range of investment options, and provide access to retirement accounts like IRAs or individual retirement accounts. One feature that's especially important for beginners, and I previously touched upon, is fractional investing. Fractional investing means you don't need to buy a full share of an ETF to get started. You can invest smaller amounts and still participate. For example, let's say there's an ETF you're interested in, and one full share costs $500. But right now, you only have $25 to invest. With fractional shares, you can invest that $25 and own about 5% of a share. Over time, as you add more money, you gradually increase your ownership until you eventually own one full share or more. This is a big deal because it removes the "I don't have enough money" barrier and lets you start where you are. One thing to keep in mind is that different brokerages handle fractional investing a little differently. For example, some platforms limit fractional purchases to certain funds or products, which is something to consider when choosing where to invest. And for people who prefer a more streamlined, beginner-friendly interface, platforms like Robinhood can also make it easier to get started. The key takeaway is this: you don't need thousands of dollars, you don't need to be an expert, and you don't need to have everything figured out on day one. You just need a brokerage that fits your needs and the willingness to start. So let me walk you through exactly what that looks like, step by step. But before we jump into the steps, I need to quickly point something out. Even if you already have a 401k or an IRA, you still need a brokerage account because they're not the same thing. Retirement accounts are restricted and for long-term, tax-advantaged investing. But a brokerage account gives you control and flexibility to access your money and build wealth on your own terms. And having both, that's where things really start to work in your favor. Okay, let's get started. First, you'll need to choose a brokerage. This is simply the platform you'll use to buy investments. Think of it like the store where you shop for stocks and index funds. For U.S. investors, well-known, reputable options include Fidelity, Vanguard, and Charles Schwab. Some key things to look for include no account minimums, or very low ones, low fees, fractional share investing, plus an easy-to-use interface. There is no perfect brokerage. The best one is the one that helps you start. Once you've picked a brokerage, you'll open an investment account. This usually takes about 10 to 15 minutes. You'll be asked for your name and address, social security number for tax reporting, employment info, and bank details to fund the account. This is all standard. It's no different than opening a checking account. Next, you'll choose what type of account you're opening. For beginners, this is usually one of two: a taxable brokerage account or a tax-advantaged retirement account. For now, we'll start with a taxable brokerage account. You can always add a retirement account later. Okay, now you're ready to move money into your investment account. Most brokerages let you link your bank account, transfer money electronically, and start with as little as $5 to $25. So you don't need a large lump sum. Starting small is normal, and once your account is funded, you'll search for the index fund or ETF you want to invest in. You can search by fund name or ticker symbol. At this stage, you're not trying to find something fancy. You're just looking for a broad market index fund or ETF. And no worries, in my next video, How to Invest in ETFs, I'll walk you through exactly which funds to start with based on your risk profile. Okay, now you're ready to move money into your investment account. Most brokerages let you link your bank account, transfer money electronically, and start with as little as $5 to $25. So you don't need a large lump sum. Starting small is normal, and once your account is funded, you'll search for the index fund or ETF you want to invest in. You can search by fund name or ticker symbol. At this stage, you're not trying to find something fancy. You're just looking for a broad market index fund or ETF. And no worries, in my next video, How to Invest in ETFs, I'll walk you through exactly which funds to start with based on your risk profile. Congratulations, you're ready to place your first trade. Here's what you'll do. Click Buy, choose dollar amount or number of shares. Select Market Order. This is the default for beginners. And confirm the trade. That's it. You're officially invested. Now here's the part most people skip, but it really matters. Automation. Set it up so money gets invested automatically into the same fund every week, 2 weeks, or month. That way, you remove emotion and timing decisions. No guessing, no overthinking, just consistency. Because consistency beats trying to be perfect every time. And once everything is set up, your job is surprisingly simple. Don't check your account daily. Don't panic during downturns. Don't chase trends. Your superpower as an investor is patience. Now that you understand how investing works, let's talk about why it matters, why savings alone isn't enough, and what inflation is really doing to your money. Because understanding investing is one thing, but understanding what happens if you don't invest, that's what changes everything. Think of every dollar you earn as a tiny employee. And when you invest, your money starts working for you because those same dollars start generating more dollars, who then generate even more dollars. And suddenly, you've got an entire team working on your behalf. That's how wealth is built. Not by working more, but by letting your money make more money. Now, you might be saying to yourself, but this still doesn't get at the root of, why not just keep my money in a savings account? Don't get me wrong, saving is good, but relying only on a savings account is actually the risky move. And with inflation, the picture is even grimmer, because yesterday's price is not today's price. You feel it every time you buy groceries, pay rent, or fill up your tank. Don't you work too hard to watch your money lose value year after year? Isn't it time to flip the script? If your money is just sitting there, it's not growing. And if it's not growing, it's shrinking. Because inflation eats away at it year after year, dollar by dollar. I mean, we've all felt its impact on our daily lives over the past decade. And to put it in perspective, a basket of groceries that cost $100 in 2020 would now set you back roughly $130. That's an increase of 30% for the exact same food items. So by only saving and never investing, you're quietly falling behind, even if you feel like you're playing it safe. Safety isn't the absence of risk. Safety is choosing the path that actually gives your money a chance to grow. Still don't believe it? Let's look at a concrete example. Say you currently have $10,000 sitting in a traditional savings account. Come close so I can tell you a secret. Banks are robbing you and you're letting them. Here's the problem. Your bank, Chase, Wells Fargo, Citi, is paying you close to nothing on your savings. I'm talking pennies, while inflation eats away your cash, and while they're paying you pennies, they're loaning out your money through credit cards, mortgages, and loans, while charging everyone else 20, even 30% in interest, including you. Don't believe me? Raise your hand if you've got a credit card or a mortgage from the same bank where you're saving your money. Now think about it. Would you lend someone money for free? Of course not, unless they're family or maybe a friend. But that's exactly what you're doing when you park your money in a traditional savings account. And here's the twist. It's actually worse than lending for free because you're paying the bank to borrow your money. Let me say that again. You're paying the bank to borrow your money. So ask yourself, do you want your money working for them or working for you? This is why Warren Buffett also said, if you don't find a way to make money while you sleep, you will work until you die. And he's right, and this is why we invest. Because investing is the greatest vehicle for wealth creation. But how does it impact you really? Most people hear the word and immediately think it's complicated, risky, or something only rich people do. But it's actually very simple. It's putting your money to work so it has the opportunity to grow, without you having to trade hours of your life for it. That's it. And as I stated at the beginning of this chapter, investing is just giving your money a job. So always remember, money is the tool, freedom is the goal, never confuse the two. Okay, now that we've covered the basics of how to invest, let's talk fears and concerns that almost everyone has when they're just getting started. First up, and this is the big one, what if I lose all my money? This is probably the number one fear for new investors. And it's completely valid. You might be thinking, what if I put all of my hard-earned money into the market and it disappears? Especially when you hear about moments like the 2008 financial crisis or the sudden crash during the global shutdown in 2020. Those moments were scary. There's no sugarcoating that. But here's the perspective most people miss. Market downturns, even severe ones, have historically been temporary. And while they feel terrifying in the moment, they've also been some of the best opportunities for long-term investors. When the market falls, you're not buying something broken. You're buying ownership in strong companies at lower prices. It's the investing version of a sale. Let's make this real. Imagine you invested $1,000 right before the 2008 financial crisis. Not long after, your investment might have dropped to $500 on paper. That feels awful. But here's the key difference. If you panicked and sold, you locked in that loss. But if you stayed invested, the market eventually recovered and went on to reach new highs. The same thing happened in 2020. Markets dropped fast, headlines were terrifying, and fear was everywhere. But investors who stayed the course were rewarded as markets rebounded and continued to grow over time. This is the lesson. Volatility is normal. Panic is optional. And this idea isn't unique to stocks. It applies to real estate too. If you buy a house and try to sell it a month later, you might lose money. But hold that same house for 15 or 20 years. Historically, it's likely increased in value. Investing works the same way. The longer you stay invested, the more time your money has to grow, not just through market recoveries, but through the power of compounding. Now ask yourself this. What are the chances that the 500 largest companies in the United States, companies like Visa, Google, Costco, and Amazon, all fail at the same time? If that ever happened, it wouldn't just mean the stock market collapsed. It would mean the entire economy collapsed. And at that point, we'd have far bigger problems than our investment accounts. So here's the bottom line. Stay patient, stay diversified, and stay focused on the long game. Investing isn't about getting rich overnight. It's about building wealth gradually, one decision at a time. So don't let fear stop you from starting. Every investor begins somewhere. And with consistency, discipline, and the right mindset, you can absolutely build real financial freedom. Now, you might be thinking, isn't investing just for rich people? Not at all. That's one of the biggest myths out there. Because today, thanks to fractional shares and a strategy called dollar cost averaging, you can start investing with just a few dollars. Whether it's $5, $25, or $100, what matters most isn't the amount. It's building the habit of investing early and consistently. And what exactly is dollar cost averaging? It simply means investing the same amount of money on a regular schedule, weekly, bi-weekly, or monthly, no matter what the market is doing. You're not trying to guess the perfect time to buy. You're not reacting to headlines. You just stay consistent. Over time, this approach helps smooth out market ups and downs and reduces the stress of trying to beat the market. Let's look at a simple example. Say, no matter the price, you invest just $25 a week into an ETF. That's about the cost of one takeout meal, including tax and tip, or roughly $100 a month. In January, the price is $40, so you buy 2.5 shares. In February, it rises to $50, so you get 2 shares. In March, the price drops to $30, you snag 3.33 shares. In April and May, you continue investing, buying more when it's low and less when it's high. Over 5 months, you've invested $500 and bought nearly 13 shares without ever trying to time the market. Your average cost per share? Just $38.72, even though the price ranged from $30 to $50. That's the beauty of dollar cost averaging. It smooths out the ups and downs, removes emotion, and keeps you consistently building wealth. Now, when we zoom out and look at a real-world example, $25 a week or about $3.57 a day invested in VOO, Vanguard's S&P 500 ETF, would add up to about $13,000 out of your pocket over 10 years. But thanks to the power of compounding, that could grow to roughly $30,000 over that same period. Stick with it for 20 years, and your $26,000 investment could grow to well over $150,000. Not because you picked the perfect stock, but because you stayed consistent. No stock picking, no market timing, just patience, discipline, and time. That's the magic of ETFs and the power of compound growth over time. Next up, how do I know which ETFs to choose? Because with thousands of options out there, this is where most people get stuck. But here's the good news. You don't need to figure everything out on day one. Start simple. Broad market S&P 500 ETFs give you a strong foundation without having to pick individual stocks. If you want to know exactly how to identify the right ETFs to start with and why, I break it down step by step in my next video. Trust me, this is where everything starts to come together. And finally, what if you make a mistake? You will. Everyone does. Even the pros. The key is to start small, learn as you go, and stay consistent. Because investing isn't about being perfect. It's about making progress. So that's it. The only question left is, are you ready to start? If this helped you, hit the like button, subscribe, and turn on notifications for more simple, no-nonsense guides to building wealth. And if you can, hype the video. It really helps support the channel as I keep creating more content like this for you. If you have any questions or topics you want me to cover, drop them in the comments below. Because at the end of the day, this isn't about the market. It's about your future. Money is the tool. Freedom is the goal. Never confuse the two. So let's start putting your money to work.